From Tycoon U Studios in Delray Beach, Florida, this is Options GPS with Chris Rowe and Ron Ianieri.
Welcome back to Options GPS. I'm Chris Rowe.
And I'm Ron Ianieri.
And the next thing that we're going to be talking about is the collar. The collar is a strategy that you can implement when a stock has taken off and you own it, and then the stock starts to consolidate at a high point.
Yeah, it's definitely a maximum protection position, which allows us to finance longer-term protection. You know, the protected put's a great strategy for protection, but the problem is it's expensive if you're going to try to do it month after month for a considerable period of time.
Right.
What we want to try to do is now find a way to protect that type of position over a longer period, and that means we have to figure out how to finance that long put. And what we do is we sell a call to bring in proceeds to finance the purchase of the put. So it's kind of a combination of the covered call strategy and the protected put strategy.
So basically you own a stock and you sell a call, you use that money to purchase a put. And there's a lot of different reasons why somebody might want to do this. Of course, it limits your upside potential. It limits, you know, on both sides, upside or downside potential. But a good way to use this strategy, I've found, is if I have a stock, let's just say, for a long time. There are people out there that have stocks for 30 years that they've had in their account. They don't want to sell it, but they think that the stock might tank. Now, some people out there owned, let's just say, Merrill Lynch in 2007, and they've had it since 1974 when it was down at 8, and it's split twice since then. You might not want to sell Merrill Lynch, and then you'll have to pay all the taxes on that sale. However, you see the Wall Street sector just reversed. Sector Hunter sent out an alert saying Wall Street is definitely not the place where you want to be. So then you decide, well, now I'm stuck in this stock. I don't want to pay taxes. So what you can do is hedge the position with a collar. This way, if the stock trades down, you still have the right to sell it at a higher price, and your put's financed because you sold the call in order to do that.
Right. What you're doing is you're giving up some of your upside potential in order to make sure that your rear end's covered to the downside. And sometimes that's the best trade. Sometimes it's not so much, hey, how much more can I make, but how much can I make sure that I don't lose? And that's what the collar's about.
Right, understood. And also, you know, if I have a stock position, let's just say it's up. Let's just say I've bought Microsoft from $40 a share and it goes up to $100. I've held on to it for 11 months. Well, I think it's going to tank. I might not necessarily want to sell it 11 months into the trade because then I'm going to have short-term gains and I'm going to get taxed a pretty high rate for the short-term gains. So I can hold on to the position for another month without worrying about the stock tanking and then me losing my profit just because I didn't want to pay the higher tax rate.
That's exactly right. It buys you time is what it does. If you take that collar out beyond the 1 year mark of your position, then what winds up happening is that no matter what the stock does, you still have that collar in place. It's protected. So while you're waiting for that 1 year anniversary to come up so you can actually move into long-term capital gains, meaning a lot less tax, probably, about 50% less, then you remove the risk of while you're waiting, the stock drops and you lose all the profits anyway.
Right.
So the collar is perfect for that. Right. And for anybody that has restricted stock, too. There's a lot of different uses for the collar.
Well, I mean, managing money, I had a lot of different situations where people came to me and they said that they have a stock, they think it's going to tank, but they don't want to sell it for any number of given reasons.
Or they can't sell it for any number of given reasons. So.
All right. Well, what do you say we talk about what it is and how it works, and then after that I'll talk about the best time to implement it.
I will go start teaching the collar.
All right.
When we were talking about the protective put and the synthetic put, we had said that as a protective strategy, both of those were premium outlay strategies, which could be used well in short periods of time, but not so good for a longer period of time because of the amount of outlay, capital outlay we'd have on a regular basis. We'd have so much extrinsic value month after month after month decaying on our face that these two strategies wouldn't give us a real good long-term protection. That's where the collar comes in. What is a collar? Well, the way the collar is constructed, it's long stock, short call, long put in a 1-to-1-to-1 ratio. Now, when you first look at this, you might say to yourself, hey, long stock, short call, long put, that sounds just like a conversion. It does sound like a conversion, but the difference here is that a conversion would have the put and the call being corresponding options. Both the put and the call would have the same month and strike. Here in the collar, these are not corresponding options. We're going to look at an out-of-the-money call and an out-of-the-money put. So they're going to have different strikes. Same month, different strikes. So although the collar has the same components as a conversion, it's not a conversion because the put and the call will be of different strikes. What we have here is a maximum protection strategy at a very affordable cost. Quite often, there is no cost. A lot of collars are done for a credit even. You might actually collect money. So we've got a maximum protection strategy, and it's at a very, very affordable cost. The nice thing about this is that because I'm not putting out so much extrinsic value every month, I can use the collar to protect a position for the longer term. And we saw that when we were looking at the morphing of our protective put and our synthetic put. There's a point in time we said, hey, if the stock stays where it is and we wanted to extend our protection, a couple months was fine, but if we had to go longer term, we were going to go with the collar. And here's the collar. Now, the collar is a premium neutral strategy. Does that mean that every time you put on any collar, it's exactly premium neutral? No. Sometimes there's going to be a credit assigned to it. Sometimes there'll be a small debit. But the fact of the matter is that it's not a very expensive strategy. You get maximum protection for minimal cost. When we're in the collar, we have to understand we are mildly bullish. We are going to be fully hedged, but we are mildly bullish. Just think of the long stock position. Normally, most of your positions, in terms of their delta, are going to follow the stock. Why is that? Because most of the positions that we have are 1-to-1 ratios. And when you're 1-to-1 with the stock and you're an option, odds are the stock is going to carry more delta than you do. So we are going to be mildly bullish here. What the collar is a combination of the covered call strategy and the protective put. This long put is going to act just like the long put that we used in the protective put strategy to protect our long stock position. This short call is going to act just like the short call in the covered call strategy. It's going to collect premium for us. The put is going to be a premium outlay, while the call will be a premium collection. Hopefully, if we set it up right, those two offset, and we have this put protecting our downside for free. So which collar are we going to use for protection? There's a lot of different potentials here. What strikes are we going to look at? Well, there's a lot of different strikes we have. We've got an in-the-money strike, we've got an out-of-the-money strike, and we've got an at-the-money strike. Normally, when we're doing a collar, we're going to look at the out-of-the-money strike. I very rarely buy out-of-the-money options, but when I'm doing a collar, I'm going to be looking at buying a slightly out-of-the-money put. Think about that protective put. It's almost like a stop order in a way. You really don't want to put your stop order in at the exact price that you just bought the stock. You normally want to have a little wiggle room. You're willing to lose a little bit of money to give the stock some room to bounce up and forth, back and down and around. We know that stocks move. They fluctuate. We don't want to have no room for the stock to fluctuate. So we're going to look for a slightly out-of-the-money put. As far as the call goes, after you buy your put, you now know how much premium that you're putting out. No pun intended. And now that you know how much you've spent, you can figure out which call to sell, because we could just simply sell a call that's going to be bringing in the same amount of premium as the premium we outlaid for the put. So if we bought a $2 put, we can go to an out-of-the-money call and sell a call that's around $2. We don't need to really make money off of the collar. We don't need to have a credit. We could just offset the value of the put. That is normally enough. Which month? Well, that's a good question. Obviously, knowing that we have the protective put strategy and the synthetic put strategy, and they work well in shorter time frames, I don't think we really need to collar a stock in the front month. The collar is more a longer term type of protection. So which month are we looking to collar? Well, normally it's going to be an outer month, sometimes a leap. And we might do it for different reasons. But normally, people put collars on in the out months. Reason being is that the protective put and the synthetic put spend too much money protecting us in longer periods of time. So the strategy is premium neutral. We don't have cash going out. We don't have cash going in. We actually have a neutral situation in terms of our premium. The long extrinsic value of the put is going to be decaying against us. We know that. Every day that goes by, that put is going to be decaying. Theta. But we have a short option, don't we? We're short a call. The call is going to decay for you. So if at the rate the put is decaying, the call is decaying. This put is decaying against you. The call is decaying for you. These two values, the actual thetas, offset each other, giving us a premium neutral strategy. Now, if the options are equidistant from the stock, the extrinsic values of the two options should be equal. There's where our offset comes in. If we have the same amount of extrinsic value in the call as we have in the put, one long, one short, and both expiring at the same time, if their extrinsic values are equal, they will decay equally, and we should get a nice offset. The put that we need for protection will now be financed by the sale of the call. That's where the premium offset comes in. An equal amount of extrinsic value in an out-of-the-money put and an equidistant out-of-the-money call. Let's take a look at the profit and loss of the collar. Although a premium neutral strategy, the collar can still make money. Yes, it's a great defensive weapon to protect our stock, but we still have room to make money here. Let's take a look at how we're going to do that. First, we must find the break even of the collar. What we're going to do is we have to know what that net debit or net credit of our option trade is. Remember, we've got two options involved here. We've got a call and we have a put. We're going to be selling the call and we're going to be buying the put. If the call is trading higher than the put and we're selling the call, we'll be bringing in more money than putting out money. Remember, if the call's more expensive, that money's coming in. If the put's less expensive, we have less going back out. We're going to actually have a credit trade here. We're going to be receiving money to set up our collar. Meanwhile, if the put is more expensive and we're going to buy that one and we're going to take in less from the call than we have to put out for the put, that's 3 times I've done that now. We have a situation where we've got to debit. We've got to lay money out. So once we figure out whether that combo, and that's what it's called, a combo, whether that combo of the call and the put adds up to a debit or a credit, we can now figure out the break even. All we need to do is take the stock price plus the debit will be our break even. Or if we have a credit trade, it'll be the stock price minus the credit. One or the other. But you need to know whether or not you've got a debit from this put call combo or a credit. And then we can figure out the break even. Point of maximum profit. I shouldn't even show you this. You should know what this bullet point's going to say. Think about it for a second. Remember our rules. When we are short an option, where do we want the stock to go? Directly to the strike. When we're long an option, where do we want the stock to go? As far away from the strike as possible. So, if we're short one strike and long the other, where do you think we want the stock to go? To the short strike. Our maximum profit is going to be at the strike of our short call and above. If the stock price at expiration is at the strike of the short call or anywhere above that, we will have our maximum profit. Meanwhile, if we were long an option, where do we not want the stock to go? Directly to the long strike. Our point of maximum loss will be right at the strike of our long put. If the stock closes at expiration right at the strike of our long put, we will have our maximum loss. Let's take a look at a return example for the collar. Say we buy the stock at $60 and we decide that we need some protection and we decide to buy the 55 strike put for $1.50. That's not too bad if we only have to do that for a month or two. However, if we had to do this over the course of a year or 2 years, putting out $1.50 every month, month after month after month, is going to start getting very, very expensive. So what do we decide to do? We decide to sell the 65 strike call to help subsidize the purchase of the put. At the time, both the call and the put were both trading for $1.50. That means our combo is not going to be a debit. We're not putting money out. It's also not going to be a credit. We're not bringing money in. We spent $1.50. We brought in $1.50. The premiums have canceled each other out. So what we have here is a potential maximum gain of this strategy of $5. What happens here is if the stock trades up to 65, we know that the 65 call will be worthless. That $1.50 disappears. The 55 put will also be worthless. So then all we have now is the stock. Remember, the call on the put, we had $1.50 coming in. We made here on the call. $1.50 we lost here on the put. They cancel each other out. They actually canceled each other out when we first put the trade on. Now we just have the stock. The stock trades from 60 to 65. We've got a $5 maximum gain. Anything above 65, our call will limit our profitability. So we've got a $5 gain, and that occurs right here at the strike of the short call. Remember what we said, point of maximum profit is at the strike of the short option. Our percentage return on investment is going to be our total profit divided by the initial investment. In this case, our initial investment is $60. We put out nothing nor took in nothing from the combo, the call and the put together. So we have a $60 investment. We just made $5 off this month. That's if the stock goes to 65 and we have our maximum gain scenario unfold. Meanwhile, what's our maximum loss? Well, we know where it's going to occur. It's going to occur at the strike of the long option, this long 55 put. If the stock trades at expiration down at 55, and it's sitting at 55 when expiration occurs, the call and the put have already offset each other. All we have left is the stock. The stock that was trading at 60, now 55, will lose us $5. And that all occurs here at the 55 put strike. Now here's the thing. If the stock goes any lower, we don't lose any more money. Why? Because this long put will then be in the money. And this long 55 strike put will give us the right, but not the obligation, to sell this stock to someone else at 55. The stock that we bought at 60, we now have the right but not the obligation to sell to somebody else at 55. So if the stock fell below 55, we would exercise our rights, exercise the put, and sell that stock at 55 to someone else, thereby locking in a maximum loss of $5 and $5 only. It doesn't matter how far the stock goes down. We have the right to sell it out at 55. When we take a look at the collar strategy here, what do we see? Well, the first thing that should catch our eye is the fact that we have a limited upside potential gain. That limited gain is due to us being short the 65 call in that last example. The 65 call is going to limit our profitability on the upside. But meanwhile, on the downside, we also have a limited loss, which is really what we were looking for. Our limited loss is given to us by the purchase of the 55 put. We know that we have room to make money on the upside. We have room, of course, to lose money on the downside. But once we get down to 55, where we'd have a $5 loss, it doesn't matter how much further down the stock trades. We're limited here. We have a break even up here, as you can see. That will be told to us by either whether or not we've got a credit from the combo or a debit from the combo. What about the Greeks of a collar? This is going to be a little tricky. We know we have a long delta position. That's easy because we have the long stock, short and out of the money call, long and out of the money put. So if the call and put were both, say, 35 delta, we would acquire short 35 deltas from the long put, short 35 deltas from our short call, giving us a total of negative 70 deltas. But the stock is 100 deltas. We're still going to be long delta here. Now it gets a little tricky, but not really importantly tricky. And what I mean by that is that once we're in the collar, we're not going to be all that concerned about our Greeks. We have a limited risk, limited reward. We know exactly where the stock is going to be in between there and how much money we'll make or lose. So the Greeks in this position aren't quite that important, but you will see them fluctuate. Gamma is going to be determined by the stock's proximity to the strike. Remember, gamma, vega, and theta are strike-based Greeks. They get their value based upon the strike. And we know that when the stock is directly at the strike, and that strike is now the at-the-money strike, it's going to have the heaviest gamma, vega, and theta. But we have two different strikes working here. One long, the other short. If the stock is closer to our long strike, the long strike, the 55 put, will now become the at the money. It's going to have a bigger positive gamma than the out of the money 65 call strike. The 65 call strike, being that we're short that, is going to have a negative gamma. But the bigger gamma lies at the money. So these strike-based Greeks are always guided by the strike that's closest to the stock price. If we're down near the long strike, we'll have a long gamma. If we're up near 65, the short strike, then we're going to have a short gamma. But we don't really need to get too concerned about this because we've got a limited risk, limited reward position. We know we can only make $5 up at 65, and we know we can only lose $5 down at 55. So we're not really, shall we say, concerned about the gamma. But the reason I'm telling you this is if you are watching your Greeks like you're supposed to, you're going to see your gamma go from short to long to short to long as the stock fluctuates between 55 and 65. Up near 65, short gamma. Stock trades down toward 55, long gamma. Whichever strike is at the money at the time is going to be the heavy when it comes to gamma and the other strike-based Greeks like theta. Same situation. we're going to have a positive theta if the stock is somewhere around the short strike. If we're up around 65, our short call is going to be collecting premium. It's going to give us a positive theta. If we're down around 55, we're long that strike. It's going to have a big extrinsic value now that it's at the money. It's going to give us a negative theta. So it really depends on where the stock is positioned in relationship to the two strikes. Vega is no different. Same story. It's going to be determined by which of the strikes is closest to the stock. Whenever we have the stock near the long strike, we're going to be looking at long gamma, long vega, and short theta. If we're down near the, up near the higher strike where we're short, we're going to be short gamma, short vega, and long theta. And as the stock is trading back and forth, we're going to see these values go positive, negative, positive, negative. I just don't want you getting spooked by every time you open up your position, you've got a different vega, different gamma. Not just different in terms of smaller or bigger. I'm talking about dramatically different between plus and minus. It's nothing you really need to be concerned about in the collar. I just want to make you aware that these numbers are going to change. Sometimes positive, sometimes negative, as the stock trades in between the two strikes. Whichever one it's closer to will be the heavy for gamma, vega, and theta. So why are we going to use a collar? Got to be a good reason. Well, first is to lock in longer-term profits. Some people, for some reason, just have to own stock. And they've got to own it forever. That's just what they do. If you're one of those people and you've had a nice move up in your stock, don't just sit there and watch as that profit disappears. Lock it down by collaring it. It doesn't cost you anything. You might even get a credit out of it. Please lock in those profits. The collar is perfect to do that over longer term. Cost efficiency. We can't keep buying put after put after put, month after month after month, and putting out the premiums to own those things. They will basically take away everything we have. All of our profits will just disappear in buying these insurance policies. Use the collar. It's cost efficient. It's going to be done potentially for credit. You might actually get paid to do the trade. Lock it in with the collar. Protect it with the collar so you don't spend too much money in protecting your position. Here's a neat one. How about short-term tax avoidance? Think about it. If you bought a stock at the beginning of the year, and here you are in October, you've got a big profit, and you look at it and you say, you know what? If I sell this stock out right now, being that I've only had it for 10 months, I'm going to get hit with short-term taxes, aren't I? That means my profits will be taxed as regular income. 30% maybe? However, if I could wait for just another couple months, just get me over that 1 year period of time, then I'm at long-term profits. And they're taxed at the long-term rate, which is considerably lower, about 15%. There's a big difference between 30% and 15%. And all we have to do is wait just 2 more months, and we'll get over that 1 year anniversary of our stock purchase. What do you think is going to happen during those 2 months while you're waiting? The stock is going to drop. Don't let that happen to you. Go out beyond the 1 year and collar the stock off. That way, if the stock does drop, no big deal. You've locked in at least the majority of your profits, and you've locked them in for over a year. Come time when the month is here where it's expiration and your collar's going to expire in month 13 or 14, you can now sell out your stock and not worry about the taxes. Great for short-term tax rate avoidance. It's also nice for the protection of restricted stock. Now, the problem you're going to have is your broker is probably not going to let you do a collar without having the stock. And if you have restricted stock from your company, odds are you don't have the stock in hand to have the broker hold. So how are we going to do this? Sometimes with big blocks of shares, you can actually contact a brokerage firm that will make you what is called an over-the-counter market on a collar for your restricted stock. One of the situations that happened to a lot of people in the dot-com era is that all these young people suddenly build a company, the company goes crazy, they sell out, but when they sell out, they're not allowed to sell all of their shares immediately. Quite often, they had to hold those shares for a year, 2 or 3 years. Well, think about if you were one of those people that just built this dot-com company. Here you are in 1999, and you say to yourself, "Hey, I'm selling the company out for $100 million. They give you $1 million up front and tell you you're allowed to sell the rest of your stock 2 years from today. Uh-oh. But that's 2002. What happened then? Your company probably went to zero. Meanwhile, you could have had $100 million in your hands. Now you only have the $1 million you were given because your stock is gone. Don't let that happen. Take a look at potentially getting a market in an counter, an over-the-counter market in a collar. If you get that over-the-counter market in a collar, you can use it to protect the price of your restricted stock. So how is this constructed? Collars do have some flexibility in construction. We don't have to use the out-of-the-money call and the out-of-the-money put. We can use something in between. For instance, if we want tighter protection, if we don't want to lose as much, we can actually buy the at-the-money put and sell the out-of-the-money call. Now, the out-of-the-money call will not be trading as high as the put. That means that you're going to be putting out more than you're bringing in. That's going to be a debit trade. When you do a debit collar, you normally have more protection and quicker. That means you have less to lose. If you decide that you want looser protection, you don't want to be that protected, you want to have more room, then what you can do is buy an out-of-the-money put and sell the at-the-money call. You don't have as much protection, but you're going to get a bigger credit. You're going to get more money up front because the call that you're selling at the money will bring in more money than the out-of-the-money put will cost you. When are we using these collars? When we're seeking long-term protection for a long stock position. Wouldn't you have loved a couple of years ago when the market was high and beautiful? Wouldn't you love to be able to collar your stock before the market goes down? Wouldn't you like to be able to do that? You say, hey, this stock is beautiful. I mean, it's a nice run. It's up at its highs. Let me collar it for a while, just in case. So you can actually protect your longer term positions with your collar. It's also good for protecting the actual profit. It's not just the position that needs to be protected. It's the dollars that we've made. That also needs to be protected. The collar allows us to do that. And finally, when we're trying to lock in profits but still leave a little room for continued profits, we definitely want to look at the collar. Sure, you could sell the stock out, but if you sell the stock out, you don't have any more room for further capital appreciation. In the collar, depending on the construction, we can have a nice base of protection from a put and enough room to the upside to really let the stock run. Now let's take a look at some situations where the collar would be very appropriate.
All right, well, I thought that was excellent.
Well, thank you very
Good
much.
job. Now I know how to hedge my positions when they're up and I don't want to sell them.
Well, there's a time and place for every position, and there's a time and place for the collar. And what we want to do as investors is make sure that we identify a charting pattern, and then select the proper strategy. There's going to be several that could work at any given time, but we have to make sure that we use the most optimal strategy at any given time. And one of the things is when after we have a nice run like that, quite often, as you said, a stock could get a little toppy and then start a sideways consolidation. At that moment in time, we might want to collar it off until we see what the next movement is. And then obviously we could go ahead and adjust the position once the market tells us whether the stock's going to continue or fall back off. So why don't you show us how to find one of those situations?
All right. Well, I mean, just I want to touch on something that you said first. You can tell what's going to happen with a stock or what's likely to happen with a stock because a term that you use, the market will tell you. So the market speaks to you. Basically, when you see certain charting patterns, the market's telling you something. It's just a picture of human emotion. So you can tell when both the buyers and the sellers basically agree on the same price. So when there's a consolidation pattern, it's basically what's happening for the time being. Buyers are waiting for the sellers, and the sellers are waiting for the buyers to make a move, and they're waiting to see who moves next. So I'll show you how to identify those consolidation patterns right now.
Perfect.
All right. Okay, so of course we've all been in the situation where we own a stock and the stock trades higher, and it has such a great run and it looks like there's a lot of strength behind it, so you don't want to sell the stock. At the same time, you want to lock in some profits. You think you see a couple of red flags. It's not always that you see it charging higher and you see 1,000 reasons why it's going to continue. Sometimes those reasons start to disappear. You might see flags pop up. So that's when the collar is the best scenario. You own the stock. Basically, you're selling the long call that's out of the money. You receive that money, and then you use that money to buy a put option. You're hedging your position on a pullback. Well, here's the best time to do it is when the stock is trading in a tight range, consolidating after having a large run-up. So, I mean, you buy Amazon down here. Now, if we expanded this chart, you'd notice that right here, this is a major point of resistance that it had in the past. But I'm just going to show you that right here you have resistance, and so that becomes a key level that we're going to keep in mind later. So when I'm buying the stock anywhere around here, I'm going to look at this as a key level that I'm going to want to keep in the back of my mind for another time if the stock moves higher like it did. And remember, always take a synergistic approach to analyzing the stock or the stock market. It's important to look at a lot of different signs that all coincide with the same price. I talk about that in the internal strength system all the time. Internal strength system students know. Always take a synergistic approach to investing. Don't just see a couple of signs that tell you to do something because you want it to work so badly that you're making it work for you. So what we're going to do is identify past resistance levels. Right here is obviously a key level of resistance. And you can see that the market, well, I call the stock the market, Amazon, popped up on heavy volume. And then you could see that it took a lot of volume to get it past this resistance level that you could have extended out here. That's why this was such a big deal. You could see it also acted as the new support level once that resistance level was broken. Now, once this resistance level was broken, you want to look at the volume on which that happened. And it looks like it was about at least 5, maybe 10 times the average daily volume right here. So that equals validity, and that means that this pop is probably real. So that's confirmed when you find that the stock bounces off the old resistance level and becomes the new support level right there. Now, once that happens, you're going to look for the new resistance levels. After the breakout, the stock hit about $69 and then retraced a little bit. Now, we're following the volume. Keep that in mind. So we see the big volume breakout right here. You can see that, usually when institutions come in and they buy millions and millions of shares of stock, they're not playing it just for 5 points or so. They're not playing it for a 10% move. They're playing it for a much bigger move. So when you see the institutions come in, they've spent millions of dollars on research before they made the decision to do this. You can assume that they probably know the stock a little bit better than you. But what you're going to want to do is use your analysis and follow the next breakouts. So you can see that right here, this is a level of resistance. That level of resistance was broken, becomes new support, but only slightly. And when that happened, it happened on pretty light volume relative to this breakout, and even relative to the rest of the volume that you see here. It was slightly higher than the volume before it and after it, but not so much volume as you see right here in this breakout, maybe about a third of that volume. So it's kind of suspect. Now I own Amazon. I want to hold on to the stock. I don't really want to sell it. I'm saying to myself, all these institutions bought right here, and I know they didn't buy it for 5 points. So I see a little breakout here with light volume. starting to question it. I'm not necessarily bearish, but I'm starting to question it. Now, a lot of different things happen here. We tried to break out on heavy volume. Buyers came in and they bought the stock and they fought pretty hard because they threw a lot of money at it, meaning they bought a lot of shares. And you could see that it failed. It was actually a failed breakout. Now, we could tell that the buyers are hungry just by seeing this upside volume right here. So we know that the buyers are hungry, but we know that the buyers failed at the same time. So we own the stock, we're long, we think it moves higher. Obviously, someone with deep pockets also thinks that it's going to move higher. But the sellers did not let the buyers overcome them. And you could tell that because the stock did not move above this resistance level that's known to everybody who follows charts. At the same time, what you see here is an RSI sell signal. And it's only slightly, barely, an RSI sell signal. Because what that is when the RSI moves above 70, it's not a sell signal until it moves below 70. Here it just touched the 70 line. It might be exactly at 70 and then moves lower. So maybe you don't want to sell too early and miss a big run. Maybe you want to hedge your position because it's a little bit suspect that you have this signal here and the buyers weren't able to push through this resistance level. So what you might want to do at that point is you want to initiate your collar, you want to hedge your long position, lock in your profits, and allow yourself to make more money if the stock runs up a little bit.
Check out how Ron matches options to Chris's analysis. We've got a bonus video online for you now.
Well, thanks for that, Chris. It really shows people a very easy way and a smart way to, find these types of consolidations where a collar might be justified and viable.
Like I said, the chart patterns are just a picture of human emotion. So if people understand that, then they understand what's most likely to happen next.
Yeah, I mean, the charts obviously aren't a crystal ball. We don't know for sure, what's going to happen ever. But the one thing is I firmly believe that they increase the probability and the likelihood of us getting a better idea of what the stock's going to do, right. And that's critical.
Well, the key is just understanding when something is more likely to happen and when it's more likely to not happen. And when it's about 50-50, that's a situation that you basically want to steer clear of. So when you understand chart patterns and you understand what it's telling you about the way that the market feels about a stock or an ETF or even just the general market itself, then you have the best idea of when to implement these strategies. The best you could hope for is really being right 7 out of 10 times. I mean, that's if you're really good.
Yeah, and the nice thing here is that, the collar's kind of buying us time. The stock has made a movement. It's now going sideways. We don't know what the next movement is. I mean, we can obviously get a better idea, but we, more importantly, don't know the timing of it. And the nice thing is that once you're in the collar, as you're playing that sideways pattern, if the stock does decide to break out of that channel it's in, we can very easily morph the collar into a position that now takes better advantage and is optimal for that next movement. The collar, like every other strategy, has a quick, morph, and it has its roles.
Well, the good thing about using options to hedge your positions in situations like when you use the collar is that, when you don't use options and you're just a stock trader, either you're dead right or you're dead wrong. There's no you were kind of right, there's no in between, there's no gray area. But when you use hedging, positions like the collar, if you use hedging strategies like that, then you're not dead right or dead wrong. You might be wrong that the stock was about to turn around and tank. The stock turns around and moves higher. You're still making money.
Right, and individual investors don't normally lose money a little bit at a time consistently. They normally make a little bit of money consistently, and then they have that one big massive loss.
Right.
If we can eliminate that massive loss, think about how much better everybody would be. And sometimes that massive loss comes early before the investor gets to a point where they've got, experience. It's not just a, textbook in their head. They've practiced it. They're out there. They're doing it. And what winds up happening is before they really get to that point of ultimate experience to where they're confident, they have that one big loss, wipes them out. Their confidence is shot. They have no money. And it takes a long time to come back from that.
Yeah, I mean, the stock market's not as happy of a place when you're spending most of your time trying to get back to break even. A lot of people out there are in that situation, though, and we're going to show them how to get out of that. And, we have to remember, just like some of the other positions, the other strategies that we've been talking about, with every change in one of these variables, it becomes more ideal to change the situation and so that it fits exactly where it is that you want to be. So anytime the stock moves up or down or volatility increases or decreases, time passes, which tends to happen every now and then, well, what happens is, yeah, well, not for you.
No,
I mean, your aging process has just stopped about 145 years ago.
I thank you very much.
But basically, what you want to do is you want to morph and you want to roll just like some of the other strategies so that you're putting yourself in the ideal position in terms of all the variables that go into the price of an option.
Yeah, and what they say is at any given time, your opinion should match your strategy.
All right.
Or your strategy, more importantly, should match your opinion. So why don't we take a look at how we can go ahead and change our opinion and change our collar into something else when the time comes.
All right, let's show us what you got.
Now let's talk about the setup of our collar. First, we're going to buy 100 shares. Now, do understand we might already have these shares. We're going to buy them in a 100-share lot, though. We could possibly buy the shares and do the collar all at once. But you're going to learn that you're not going to need to do that because there's another strategy that's much easier than this, which is going to be synthetically the same as a collar, but it won't involve the stock. So if we're really talking about doing the collar, odds are you've already bought the stock, you already own it, and now you're looking to protect it. So what are we going to do at some point in time when we're long these shares? We're going to finally decide to collar it, and we're going to buy one out of the money put for every 100 shares. Then we're going to sell one out of the money call for every one put that we purchased. This way, our calls will finance the purchase of the put. And we are going to try to match the expiration month that we're using to the amount of time that we think that we need the actual protection. If we don't need the protection, we're probably not going to do this. So if we have a general idea of how long the protection is needed, then that's the month we want to go out and put our collar on it. So let's take a look at an example of one. Let's actually build a real out-of-the-money collar. Well, we know we own the stock. We already have the stock. The stock is trading at $60. We decide we're now going to collar this thing. We go out and buy the 55 strike put, which costs us $1. And in order to finance that, we're going to sell the 65 call for $1.25. Look at what happens here. We're bringing in $1.25 from the sale of the call, and we're only putting back out $1 for the purchase of the put. This is a credit to us. We've got to understand now how that credit applies to the overall position. Our maximum gain is going to be $5.25. Why is that? We can look at it in a couple different ways. The first way to look at it is that we know that our point of maximum loss is where? Right here at the long strike of the put. We always said that the last place we want the stock to go is to that long strike. If that's true, then we know with a stock that we bought at 60 and the stock is now down at 55, we know we've got a $5 loss there. With that $5 loss, we have to remember something. We received a credit for doing this trade. That means that that $5 loss is actually going to be a little less. Less by how much? By the credit we received. We have a 25-cent credit here. Instead of a maximum loss potential of $5, our maximum loss potential would be $4.75. On the other side, though, is where our gain is. If the stock went up to 65 from 60, that's a $5 potential gain. But don't forget about the credit. We received a 25-cent credit. So where our maximum gain looks to be $5, we've got to add the credit in. Maximum gain, $5 plus the credit of 25 cents. Maximum gains $5.25. Our break even is going to be the stock price either plus the debit or minus the credit. We have a credit here, so we're going to subtract 60, which is our stock price, minus the 25-cent credit gives us a break even of $59.75. So our maximum gain will be from $59.75, which is our break even, up to where our point of maximum profit is, 65. That's how we get the $5.25. Thus, our maximum loss will work the other way. 59.75 is our break even. Our point of maximum gain is where? 65. So our point of maximum loss is here at 55. We know that we get our maximum gain where we're short the option. That strike, the stock trading right there, 65. We have our maximum loss where we're long the option. That would be the put, the 55 put. So if we now are trying to look at our maximum loss, we want to look at the long option, and that's at the 55 strike. Our break even down to the 55 strike would be $4.75. That would be our maximum loss. So what are the keys to success? I mean, how do we make these collars work for us? Number one, again, we've got to have a general idea of where the stock is going. The only reason we're going to put a collar on is because we have a stock that's currently trading up, that we have a lot of profit in, that for some reason we're concerned about the stock potentially trading down. Why would we be concerned about that? Because maybe we saw something technically in the charts, or we've seen something fundamentally with the industry the stock's in that's now making us nervous. If we're nervous, we don't necessarily want to get out. We could be wrong. What we can do is use the collar to protect what we have, still giving us some upside potential. Don't purchase too much time. This isn't as important. The reason being is the collar normally sets up for a credit, because we know that the call normally trades higher than the put by the amount of cost of carry. And that means that there's only 4 months in the year that the put could potentially trade higher than the call, and that's a dividend. So that means the other 8 months, we're probably getting a credit for the collar. So don't worry too much about purchasing too much time, because you're not spending anything. Don't purchase too little time either. Remember, if we're looking at a shorter term, a quicker nervousness that we have, we can just simply use the protective put strategy. But if we're worried about the longer term, then we have to go with the collar. So odds are you won't have to worry too much about purchasing too little time, because the collar is really going to be used in a longer term situation. You need to understand the value of the combo, that short call and long put. You've got to understand what the combo does in terms of whether it creates a debit or credit, and how to apply that debit or credit to your break even, to your lower strike to figure out where your maximum loss is, to the upper strike to find out where your maximum profit is. And always remember that in the collar, you are still bullish. You still own the stock. You are still long delta. You haven't given up on the position yet. You've just really locked it down to make sure that you are going to get the money that you made. Now let's talk about trading the collar. What if the stock goes down? Actually, we put the collar on to protect us from this exact situation. Don't think you're not going to lose some money. You are. We know we have some downside risk, but we've limited the risk, and we fixed it to an exact certain point, hopefully a point that we can live with. Because if you set up your collar to have a downside protection, but that downside protection doesn't kick in early enough, then you're going to wind up losing more money than you really want to. You can actually build these collars and customize them to be the way you want them. So, what if the stock goes down? What about rolling? Rolling's not applicable here. We have that put at that strike for a specific reason, because that's the level that we want to stop the loss at. If we roll the put down, all we're doing is then allowing us to lose more money to the next point of protection. We don't want to do that. We've got to leave the put in place. Potential morphs. Hey, if the stock is going down, we already have a collared position. We know what we're going to lose. What we want to do is, if the stock really starts to move down, is forget about the collar. it is already taken care of. It's already in a position of limited loss. We almost want to initiate another trade. Let's buy the first or second month at the money put. If the stock is really trading down and we're collared, we've already addressed the loss in the stock. We're already there. We already have the protection on it. But if the stock breaks down as it's trading down, there's money to be made on the downside. We know the fixed loss of the collar. We can buy a front month or second month put for the breakdown and try to make some money. If the stock does trade down aggressively, we use this put as a stock replacement put. We roll it down, we make money, and the money we make from playing the breakdown in this stock replacement manner, that's going to offset the money that we lost in the collar, hopefully. And you know what? If we get lucky and the stock goes far down enough, this might actually make more money than our collar loses. We might turn out to be positive overall in the trade. Closing. Well, it's not really applicable. Why would we want to close it? We already have it locked down, and we do have an ability to kind of initiate another trade to take advantage of more of the downward movement. We are comfortable where we are, so let's roll. If we had to, we need the morph. Let's just go right through closing, right through rolling. Let's just morph. Let's buy that put to play the downside. The collar is already taking care of the loss on your stock. Here we have a collar. We're out in January. We're long the January 65 put, and we are short the January 70 call, and we're long our 100 shares of stock. If the stock started trading down and really started to get hit, the collar's already covered this. What we want to do is almost initiate a new trade. We want to buy this at the money put in breakdown situation. We want to buy the put and treat it like a stock replacement put for a breakdown, which means we buy the 50 delta option and we play it on the way down. And if the stock really starts to go down, we can actually start rolling this put and treat it like it's its own position. Ignore the collar. Trade this put. What if the stock goes up? Well, we know if it goes up as high as, say, our upper strike, 70 in that example, then we're in good shape because that's where our point of maximum profit is. But what if it goes through 70 and suddenly starts gaining some upside momentum? Boy, we're going to be kind of mad, aren't we? Because when we put that collar on to finance that put, we sold the call to finance the put. The moment we sold that call, we limited our upside potential. So we're going to be missing out on opportunity cost if we do nothing. But see, we are option traders. We're going to do something. Very simple trade. Buy back the short call. If you buy back the short call, then where we're going to be, and I'm going to show you in a second, is right here. We're going to be in a long put, long stock trade. What is that? That's the protective put. We're back into the protective put, a synthetic long call. So when we buy back that short call, we free up our synthetic long call with the stock running up. Now we're back into our unlimited potential gain on the upside. That's what we want to do. That stock starts to fly. It breaks out of its range. It's now a breakout. Buy back the short call and let our protective put position run. What if the stock stays still? Well, do we need to do anything? I mean, think about it. It didn't cost us anything to get into the position. When we did the collar, we brought in the same amount of money that we put out. So we don't have decay to worry about. We don't have volatility to worry about. If the stock does trade up, we still have room to make money. If it does trade down sometime soon, we've got our collared position on and we're protected. So if the stock stays still while you're in the collar, do nothing. There's nothing to do. You're in the right position at the right time. You're protected. You still have some upside play. You can hold that position for as long as you want. You can collar something out 2 years. It doesn't matter. It's not costing you anything. If it's not costing you anything, then do you have any risk? No, as long as it stays still. Once it does start moving, if it's moving down, we do know we have risk. But that risk is protected by the collar. We don't have anything to do. So if the stock stays still, don't do anything. Well, that's about it with the collar. For those of you that have a long-term stock position and you want to make sure that you lock in the value of that position, then use the collar. Some of you might be coming up on retirement and you want to make sure that what you have in the bank right now stays there. Throw on the collar. Why? It costs you nothing. It still gives you some room for upside, but it makes sure that you don't get nailed on the downside.
Ron, you've really outdone yourself this time, I must say. All right, well, we covered the collar. Ron did an excellent job. Good boy. And so we've covered the collar. We're going to close out the collar, and then we're going to go into a couple different vertical spreads. The first vertical spread strategy we're going to cover is the bull spread. So before you do that, you know the drill. Go to the website, talk about the collar in the community with your peers, take the quiz, pass the quiz, and let's move on to the bull spread. See you there.
Okay, the example Chris found us for a collar is Amazon. Amazon had a nice run. We were long the stock, and now we've got a little downside worry. We know we've got some positions, some profits to protect here. Problem is, Amazon, when we're talking about buying puts to protect Amazon, especially for any type of longer-term time period, it's going to get pretty expensive. So what are we going to do? We're going to collar it. We're going to buy that protective put we want, but then we're going to sell a call against that put. By selling the call, we're going to generate income and proceeds to offset the value of the put we need to buy. So we take a look and we say, okay, I've got my long stock position. First thing I need to do is buy my protective put. Stock is currently trading at almost $81, $80.61. What we're going to do is we're going to go over and take a look at the 75 strike put, the May 75 puts. And we see a $2.87 bid, a $2.90 ask. We're going to buy that put, obviously, on the ask, $2.90. Now think, if you had to do that every month for any considerable period of time, say for a year, I mean, think of how much money you're going to wind up putting out, protecting this thing, you know, day after day, month after month. Too much money. We need to be able to get that maximum protection at a minimum price. That's why we're going to use the collar. Our next move is to go sell a call. Because if we sell the call, what we bring in from the call will help us offset the cost of the put. So we're buying the 75 put with the stock at about 81. And now we're going to sell the 85 call. And as you see, the 85 call is a 330 bid, offered at 335. If we sell this call, the May 85 call, for $3.30, we'll be bringing in 330 and then only putting out $2.90 for the put we need. That's a 40-cent credit on this collar. Remember how that credit is going to play into our break-evens, and that way it also tells us how much money we can make, how much money we could lose, because the collar, after all, is a limited risk, limited reward position. So what are we doing? We've bought the stock. We own the stock from previously at 81. We're buying the May 75 put for $2.90, selling the May 85 call to finance. We're getting $3.30 for that. That's giving us a 40-cent credit to lock in the majority of our profits by using the collar.